The screen is visible, right? Okay. So you have experience from the mutual fund industry, if I'm not wrong. So because when I in your resume you mention about the cap stock activity approval, income changes, trade verification, future contract. It means you're working on all the stuff, right? Okay. So my question would be NAV calculation. It means what exactly uh, you're doing in your current process.
For current process, what I am doing right now, right?
Yeah.
See, we are processing expense or daily expense accrual or any one-time adjustment if you will see any from the expense
Hmm.
we process that. Right now in this process we are not posting any stock activity, but we are reviewing from our end.
Hmm.
Like something can take that transfer reject and our yeah, for that has been posted. So we are reconciling that. Not putting a careful command. We are just reconciling about the subscription reduction. We are checking that. And we are checking like that if we have any pending things. Suppose if we say there is a stock split, so we are checking the prices and the shares.
My question is, are you producing NAV for a mutual fund?
Producing
You're verifying task. That is fine. That is a part of Recon. So it means you are ensuring all the activities those have been booked under the XYZ series or fund or class,
yeah,
right?
yes.
So that is a part of kind of reconciliation, I would say. My concern is, are you preparing any NAV pack of, or are you producing NAV and publishing to the investors? Or maybe stakeholders, I would say, all different stakeholders. Are you doing that calculation of NAV where you can actually put total assets, total liabilities, and number of outstanding units? And whatever NAV would be the are you publishing that NAV on a daily basis?
Uh, we are not actually publishing the NAV.
Then who is doing that?
I'm from kind of
Hmm.
team I'm doing that, but I have few tasks. So it is not purely to the producing NAV, but it's a part of NAV only. Like that, if we have some this early pricing fund, so we are preparing this what we can say reports for this fund report, supporting reports we are preparing for the entire day. And
So
we
what do
are,
you understand about NAV dissemination system?
yeah, dissemination we are not doing.
You are not
We are
doing.
not disseminating.
NAV dissemination means your NAV calculation.
And dissemination,
So that's the NAV report, production report, NAV production report.
so
NAV production report. Okay. Expense accruals means what is your role in that? I mean, what you guys are managing your expenses, fund expenses. Hmm.
So we receive a memo. Suppose if there are any approval changes, whether it is fixed or variable.
Hmm.
Suppose earlier it was a $10 and for fixed expense account, the client wants the expenditure to be reduced as the can say suppose the asset under their management
Hmm.
assets under custodian is gone. Then suppose the earlier the investment was of $500 and now it went down for $400 only. So
Hmm.
they want the expenditure to be reduced. The operating cost is going to be reduced. So
Hmm.
they set up memo to take the approval that is fixed or given. So we are updating that approval on a particular fund for that thing. If we have suppose an adjustment entry we receive, so we do post that as adjustment entry as well.
Hmm. So, what do you understand about accrual setup?
You know, one setup means suppose this earlier the setup was on a daily basis. The approval for an ABC fund was 1,002. Okay, so daily this ABC fund was accruing
Hmm.
$2 on a
Hmm.
daily basis.
Hmm.
Okay, now the client wants to send us a new setup. So from going forward, this fund would accrue $3. So we set up that approval on our this we call it this portal application. Usually we update this new setup on our this application. That means.
Hmm.
So from when we set up that approval, that from the fund started accruing on the required that the client wants.
Okay. So, how you calculate the mark to market value of securities?
Market calculation, calculation, we calculate markups. But for this currency fluctuation, we said the rates, depending on the rates, uh, rate that is available in the market, one is WM11, WM60, on the basis of that.
Hmm. And how you do the accounting for mark to market changes?
That I want to know, that I'm not very clear for the realized or unrealized entities, how we accounting that.
Okay.
So I'm correct with that, na? This unrealized, this mark to market calculation depend on the currency fluctuation or their.
Just keep it simple. Mark to market, it means yesterday, let's say stock price. Mark. Mark means you can say last price, last recorded price.
So it's not a cost price, right? Like that when we purchase this.
Initially, if you're recording, so that your purchase price would be your mark price.
So
Mark price, right?
yeah.
Or you can say purchase price. You can note it down each and everything, okay? Mark means your purchase price or last recorded price. To market. Market, it means it's a current market price. Current change, current price. So here you can compare it. Let's say purchase price was 100 that you recorded, and after that price changed, and now price is 120. See, you don't need to record the 120 in your book. correct? Because already you recorded the purchase price. When we purchase something, we record it in the books of fund. So it means we recorded purchase for that particular security. Now you need to adjust the market difference. You need to adjust the market difference. And that market difference, you can call it as unrealized gain and loss. Gain always that you can record to the credit, and loss always you can record it to the debit. So in this case, we have gain of 20. So you need to apply the accounting treatment to the 20 asset account debit to unrealized gain on assets credit 20 20. Okay. And when if you have a, let's say if you have loss, then how you can adjust that? Instead 120, the current market price is 80. How will you record the 20 net difference?
The difference of 40
Yep. Unrealized loss account debit to asset account
loss account
debited.
$40.
Yes. And how you can record that in P&L or balance it? See, we have two ways to record it. One is you can either apply the top line approach, or else go ahead with the bottom line approach. Bottom line approach, it means you can record it in balance it only.
Balance sheet.
Yeah, bottom it means balance it. And top line it means P&L. Bottom it means balance it. Top line it means P&L. You can add unrealized gain to the credit side of P&L if you want, and loss to the debit side of P&L. Or else you can
Gain
credit side, credit side of P&L. So, a few basic things I'll brief about.
yeah.
If I take the example of P&L, profit and loss account statement, debit side, all the expenses, all the expenses, all means all, management fees, miscellaneous fees, incentive fees if paid, right? Any prepaid expenses for that particular period, if you see, all that you can record to the debit side of P&L, all expenses, including management fees, miscellaneous fees, event fees, any losses also that if you see, any losses, depreciation, admin fees, custodian fees, all that you can record it to the debit side of P&L. Now, if I ask you to prepare the accounting entry for management fees, it's a very simple. Expenses you can record it to the debit, correct? Then as it is, place the expenses to the debit. If I ask you, let's say, fund paid management fees. Fund paid management fee, $2. When you say paid, always try to understand the paid and received word. Paid and received. Paid, it means cash will out. Automatically cash will come into picture. Cash gone out or has gone out or out, you can say. When we say received, it means cash received. When we say cash gone out, cash is the part of a real account. Real account has a rule. Debit what comes in. It's a basic, but again you can apply debit what comes in. Credit what goes out. Credit what goes out. Paid and received. Cash received. So here, all purchases, cash will out, correct?
Yes.
All sales, cash will received. Subscription, cash will received. Expenses paid, all expenses, cash will out. Redemption confirmed, cash will out, right? And if cash will out, then that becomes your credit side. And if cash received, that becomes your debit side. By default, there won't be any change. Again, I'll go back to the main accounting entry. While preparing accounting entry, whatever the debit items of a P&L would be that you can directly place as a debit. All expenses, all these items you can record it to the debit. For example, if I ask you to prepare the accounting entry in the books of fund for a fund paid management fees of $2, then your entry would be
Cash.
management fees debited. $2. Again, question would be, will management fees create any impact on net assets value per unit? Yes, all expenses and income that may have impact on net assets value of a fund. Because when we say cash, where we record the cash? Balance sheets, right? And when you paid the expenses, so it means fund is paying expenses from the cash balance. So cash will affect, and automatically there will be impact on net assets value of a fund. Now, I'll brief about all incomes. Income should be, let's say, dividend, interest payment, interest payment, then rebate. Rebate is nothing but it's a reversal of management fees, expenses, event fees, or any other, right? Reversal, it means discount that we received.
This rebate we get
Yeah, it can be from any fee. Anyone can offer you the rebate, right? Rebate is nothing but it's a discount. It's a discount. Let's say initially you recorded 100 rupees as a management fee, but later on you got the reversal. Let's say admin fees. Admin fees, it means you paid 200 rupees, but administrator reversed the 50 to you. So rebate always that would be the credit balance. And any type of unrealized gain here. Loss. See, all credit items you can record to the credit directly. How you can record to the credit? If I ask you to prepare accounting entry, let's say you have received interest payment. In interest paid by the company. What you said? Yes. Cash account debit to interest income account. Done. Then just replace the words. If you see rebate, replace the rebate. Cash to rebate, cash to dividend, cash to unrealized asset to unrealized gain. Just replace the word, right? Because in a hedge fund accounting interview or in FX, see, you may expect a lot of questions on accounting entries. How you can prepare the accounting entries.
yes, journal entry feature.
Because as a fund accountant, your daily routine job would be to post the accounting entries as much as you can, or whenever you see the changes in the maybe gain or expenses, income, liabilities, right? Then your job come into picture to reconcile those and post the accounting entries for them. Maybe in Geneva, in Westran, or apart from that, they have a different applications as well where that you need to perform the accounting entries, right? Perform the accounting entries, it means sometime that you might see the actual that you will have to record or prepare the entries manually, or sometime might be in a system you need to select the account cash and interest and update their balances. Management fees and cash means expense and cash. See, as per the traditional accounting approach, we have only, let me finish the balance sheet first, right? So now you got the idea about P&L, right? So all expenses and all income. Debit balances as it is, you can shift to the debit side if you see any accounting entry as such. The first of all, categorize it. Is it expense or income? Okay, it is a expense. It means we record it to the debit side of P&L. Then as it is, you can place that to the debit side while preparing the accounting entries. For example, miscellaneous fees. Okay, miscellaneous fees account debit as it is because we record that to the debit side of P&L. Miscellaneous fees account debit to cash. Okay, challenge would be or might be you may expect again the accounting entry on what if you have uh, you have this accrued fees and all. You haven't received it. You can prepare all these entries when you actually paid or received. P&L is not for pending expenses, okay? P&L is not for accrued expenses. Try to understand this. P&L, it is for a net income and net expense. But one impact definitely goes on P&L while recording the expenses for income. How? Just I'll walk you through it. For example, expenses accrued, management fees accrued. Management fees accrued. How you record it? Management fees accrued. Accrued, it means yet to pay. What would be
So
the
this
accounting entry?
expense payable will be debited here. This management fee for the expense management fee will be credited.
You're saying
Expense payable.
expense payable to management fees account, right?
Just one. No, this management fee account will be debited here and expense pay will be credited here. And
Hmm.
on the payment date, expense payable will be this one debited.
Always make sure payable, where we record payable. Now you can relate. Where we record payable?
When this we have to pay.
I'll simplify it. Balance it. Credit side. We call liability side. Right. We record capital, return earning, the all payables, all outstanding expenses, all outstanding expenses, redemption payable, you can record all this to the credit side of balance sheet, or in short liability side. And if I ask you to prepare the accounting entry for a management fees payable, or let's say admin fees payable, admin fees accrued. Your accounting entry would be management fee. It's a expense as it is recorded to the debit side. Sorry, admin fees. When we say fees, it means it's a expense, correct?
Yes.
Admin fees account debit, or expense account debit in short. Expense account debit to payable. It's a payable, right? Payable always will record to the credit side. Payable account credit. When you, or when actually fund paid, then payable that you need to reverse it out. Payable account debit. To cash. Why cash? Again, when you paid it, cash will out. Cash is a part of real account. So that's what we need to record it to the credit side. And why then payable would be debited? When the liabilities decreases, that would be your debit balance. When liability increases, that would be the credit balance. Correct? Note it down. You can note it down. When liability increases, then that becomes the credit balance. When liability decreases, then that becomes the debit balance. Okay. Then okay, what would be the accounting entry in case of subscription? Yep.
This subscription. Receivable account debited with the capital account will be credited.
Hmm. When you received cash, then what in that scenario, how you can record that, or what would be the accounting entry? Come on, it's very simple. Now you have idea like where you can record the capital to the credit side. You can, as it is put, the capital to the credit side. Then you need to find the debit. When we say subscription received, it means you have received cash. And when you received cash, that will be debit balance.
A cash account debited to this receivable account.
Why receivable account here?
Okay. When capital
Exactly, because you have everything front of you. I am simplifying it. You don't need to confuse. All see, just replicate as it is. Balance it's all credit side while preparing the accounting entries that you can record it or note down to the credit side. Simple.
yes.
There shouldn't be any difficulties. Let me finish out the debit side. This becomes your asset side of balance sheets. You can record here cash at bank, all buy trades,
Something on this board.
hmm? Sorry. Okay. Now cash at bank, all purchase trades, then prepaid expenses, prepaid expenses, then all what would be else purchase trades, or let's say investment including options, futures, in derivative contract, all that you can record it to the debit side of balance sheets. Now, if I ask you to prepare again accounting entry for a capital or subscription that you have received, then what would be the accounting entry? Can you tell me?
Subscription received.
Yes, or let's say you have received capital instead subscription.
account will be debited to subscription account, capital account credited.
Subscription account.
Now this cash account will be debited and this capital account will be credited.
Yes, because you have everything front of you, right? Cash, you can record it to the debit when you received it, and again, capital you can record to the credit side. So you don't need to mug up anything. Just put a logic, right? Cash that we record debit, capital that we record credit. Cash account debit to capital account credit. And when we see like receivable, all receivables you can record it to the again here debit side of assets. Here means payable you can record it to the credit, but all receivables you can record it to the debit side. So little complicated. Let's say subscription receivable. You got the message from the transfer agency, so they have received subscription, and now as accountant you wanted to record that subscription receivable in the books of fund. So how will you record it?
Debited. So our this can say receivable account debited to capital account credited. On receivable when we receive the subscription.
Receivable account debit to share capital account. Why? Apply the rule. Receivable becomes asset, right? That's what you need to record it to the debit, and to share capital becomes your liability. Where we record the liability? Credit side. Don't forget this debit and credit rule. See, might be you are already aware about this debit and credit, but I'm here to help you how you can apply the debit and credit at advanced level, right? And that's what you can link and easily understand the accounting entries. So you don't need to mug up anything. In a fund accounting also, you would see different tasks. There would be different tasks, of course, but before that, so the base should be your debit and credit that never change, whether it is a hedge fund, private equity, mutual fund, or any other account. That would be remain same anywhere and everywhere. Okay. Receivable account debit to share capital.
This share capital will be debit and payable will be credited, right? With redemption.
In redemption,
Share capital will be debited,
yep. Opposite means vice versa. And when you actually received cash, then in that case, you don't need to record the share capital reverse, because already you have posted entry for a share capital. Let's say you have received this and you recorded this. Now you don't need to worry about this portion. Apply the accounting treatment for a receivable because you recorded receivable, so it means now you have received cash. Yeah, cash to cash account to receivable account, credit, whatsoever it is. Cash account, receivable account. Correct? Yes. Same treatment you can apply to any expenses if you see receivable or paid, or any income if you see that is receivable or paid. Same accounting treatment you can apply to it. Same. And if you ask me like what would be the impact in that case, say in the receivable case, receivable again that you can record to the debit side of balance sheets, and share capital that you can record to the credit side of balance sheets. When you actually confirm the receivable, how you can means create the impact in balance sheets. Let's say this is a balance sheets, asset side and liability side. In a fund, we always take a not this is a tabular balance, it's meant in a T format. But in a hedge fund or fund business, I would say you would see the H format or horizontal balance sheets, right? We record the asset and then liabilities and then share capital in that way. So share capital we have received. Let's assume it 1,000, right? We haven't received it, but if you see your first accounting entry, this one, receivable account debit to share capital, correct? So you can record the share capital to the here, and where you record this receivable then, this portion,
Receivable will be in our asset side.
asset side.
So receivable, payable, we don't have this receivable, payable, we don't have any impact, right?
Impact, it means
Let's say this is the balance sheet, this receivable, payable. When actually we suppose this is a payable, suppose expense payable, so we don't have any impact of this item. Suppose if we say we have expense payable,
hmm, hmm,
suppose we split it out for over a year, 65 days.
hmm,
So when we record the actual entry,
hmm,
suppose we are accruing, so it won't have any impact,
hmm.
right? Or
See, expenses create impacts. That's what the point is. Expenses creates impact. That depreciate your assets. Anyways, when you paid expenses, you will pay it from your pocket. Let's say you paid my fees, right? Again, if you tomorrow if you purchase one session or two session, just think about it. You will have to pay it cash from your bank account, right? So bank account, whatever balance should be, that you will treat as assets for yourself. And if tomorrow, if you paid my fees, ultimately fees will affect on your cash balance. Am I right? So it means when your expenses goes high, your assets will depreciate. Can you relate or not?
this this share capital,
Hmm.
this share capital receive this subscription, right?
Hmm.
So how we balance this entry, so it will both have impact on balance sheet, right?
Yes. But subscription, it's not your expenses, not here. So you're forgetting the logic. This is not your expenses which you can treat. I'm talking about expenses and income. When your expenses goes high, that will affect on let me brief about this particular, let's say at the moment, like we have a receivable, and that's what we recorded this entry. So tomorrow, let's say we have, or let's say today we have received cash. When we have received cash, we recorded, we reversed out the receivable and then recorded cash, right? Then it means you need to remove this and you can add the cash at bank. Cash at bank. How much? 1,000. At the moment, you have like cash is equal to assets is equal to liabilities, right? Okay. So very next day, the admin means fund admin requested you to make the payment, and then you paid admin fees, let's say 10 rupees. But before that, let me just calculate the NAV. If I ask you to calculate the NAV, what would be your NAV?
This 1,000.
Yeah, with this data. If I ask you to produce the NAV, then you have a total 100 rupees, it means that becomes your NAV, right? NAV is nothing but it's a total of assets. Total of net assets, because we don't have a liability at the moment. And if you want to split that into units, then 1,000, that is depends on you. You can create your units. 1 rupees per unit that you can keep as it is if you want. Right? Okay. Let's say tomorrow admin asks you to pay fees. You paid admin fees. Admin fees paid 10 rupees. So how will you record this? Hmm.
So
What would be the accounting entry? Admin fees, expense account debit to cash account credit. Now try to apply the impact. Cash will goes out. 10 rupees cash will goes out. So it means he will have to pay cash from this amount, right?
yes.
Yes, no, maybe. Or you are not able to understand what it is exactly. When you paid expenses, don't you think that your cash will be affected? Then why you are confused? Cash will out. You see, if you forget the accounting logic, then you cannot understand anything. As simple as that. Cash is the part of assets. Asset is the part of real account. And when we say real account, debit what comes in, credit what goes out. Goes out, it means you have paid it
Yes.
and it has been affected. When we say it has been affected, you need to minus the expenses. Net would be 99 990. Now if I ask you to calculate the NAV, then what would be NAV? 990. Calculate the NAV for per unit. You calculate it. 990 divided by 1000 units.
Point
Right? So NAV affected or not? When your expenses goes high, then or increase, then automatically your net assets value for per units that will be affected. Then how can I adjust that? Then you need to adjust your share capital in a way. First of all, you need to prepare the P&L. Why? Because you have expenses. So you need to prepare your P&L. Debit, admin fees, paid 10. So let's say credit, we don't have anything. No credit at the moment. Then you can transfer that to the net loss, right? How much net loss would be? 10. And net loss, where we transfer? We transfer to the, come on, balance it, correct? Net loss, you need to minus from here. Again, 990. So it will die. Then you need to update your total assets. This is what your NAV production it means. Whatever changes happen, that you need to apply the accounting treatment as accountant. Right?
Yes. This is the expense paid, actually paid. The vendor cash goes off. And
Exactly.
sometimes we have this like
Yeah.
uh,
Accrual, it means, see, accruals, you are recording expenses as well as accruals. Accruals that you are recording in the balance sheet, and income or whatever that expenses you have, you are recording to the P&L. Same time. So it means, let's say you have a, now you have a management fees, not management, let's say income receivable, dividend receivable. Let's say 10. You can record it 10, and here in P&L, credit side you can record it. Now you can say dividend income. Dividend income 10. So debit versus credit, let's say, is equal. So it means no profit, no loss. Right? No profit, no loss. You have expenses of 10, you have a income of 10. There won't be any impact on balance sheets. And your balance sheet becomes like, you just need to remove this loss because there is no impact. And your balance sheet total looks like this. 1000, because there is no impact on share capital, right? Cash at bank, let's say it was 990 because expenses was there and that's what you recorded, but you have a dividend receivable 990 plus 10, again that becomes your 1000. Same to this side as well. And NAV dissemination, it means to publish the NAV for per unit. Prepare the report for per unit and submit it to the shareholders, or maybe let's say regulators or stakeholders, I would say in short, publish the NAV for per unit, compute the NAV, net assets value for per unit. That process we call it as disseminate NAV. Disseminate, it means publish. Publish. And now if I ask you to calculate NAV, then your NAV becomes total assets 1000. We don't have any liability, so no change, right? 1 rupees per unit, correct? Okay. My question is, again, let me remove this. We raise total capital, share capital. Cash at bank. Let's assume it 500. When you purchase, let's say you purchase equity, then what would be the accounting entry? Purchase equity of 500. Yes. What would be the accounting entry? Investment account debited. Cash account credited. Always, when we purchase it, cash will be there. By default, cash will be there. When we sell it, by default, cash will be there. Because all financial assets we measure in cash only. So you cannot forget about cash. So when we say purchase, so it means cash been affected. Initially it was 1000. Let's say initially it was 1000. But when you purchase it, cash affected by 500. Then we remove the cash. And we post the remaining balance, which is 500. But question is, due to normal buy and sell activity, will be there any impact on net assets value of a fund for per unit? Yeah, in case of buy, sell, whatever it is, in both the cases, would be there any impact? Yes. Why? Exactly. Yes. Now, let's say it was a Wipro security, right? So you purchased one shares. This is the data. You purchased one shares at 500. So, very next week, Wipro announced stock split. Wipro announced stock split and they have decided Wipro announced stock split and they have decided to split 10 shares for one. So it means if you are holding one shares old, then Wipro will process you the 10 new shares. Go and check your balances. You're holding one share for 500. You're holding one share for 500. And now let's assume it. You have actually received 5 shares. Again, my question is, would this stock split impact on NAV for per shares? Why? Yes. Now price will be 500 divided by 10 new shares. That means 50 for per shares. Right? 50 for per shares. So here instead one you can say 10 shares at 50 rupees. And you need to remove this. And again 10 into 50 becomes 500. There is no impact on total assets. No impact, you need to record it anywhere. But while recording that corporate action, why the corporate action validation or reconciliation come into picture? While recording, if you make a mistake, the recording of quantities or recording of price of that corporate action in the books of fund, then that will lead to the incorrect NAV production automatically. Are you getting me? For a normal corporate action event, there is no impact. But if you recorded anything incorrectly, then there will be impact. Why there will be impact? Let's say original asset was this. Instead 10, you recorded 20 shares at 50 rupees. So that becomes your 1000. It means you are increasing your asset. In a reality, you don't have that assets. Due to just you made a mistake while recording the quantities. You recorded quantities incorrectly, and that would lead to the incorrect NAV production. So now your total NAV is this, but actually you don't have the 500 extra. Correct? Yes, overstated, overvalued. I'll simplify it. If you see due to corporate action is if if is there any change in the total investment value, then that will lead to the change. The net assets value per unit. For example, redemption or delisting. Company want to delist the securities. Company want to delist the securities. Now you think, would be there any impact?
Yes, if you want to delist the security, then also holding they will be this sold out.
Hmm?
Delist the security, then there will be no holding. And
Exactly. So it means your total assets will be impacted.
yes,
Your total assets will be impacted. So in short, if you see due to corporate action, if you see any impact, negative or positive, if that would be on your investment, so it means there will be impact on your net assets value per unit as well. And if there is no impact due to action, then it means there won't be any impact on. Okay. Okay. Good. So at least you got the idea. It means how accounting works, correct? NAV production. It means now I'll come to the NAV production. So you may expect question like because you charted out few things on your resume. So you may expect question like, can you tell me about NAV package? Can you tell me what activities comes under NAV package?
This
Yes, cap stock activity, trade processing, M to M, then expenses, income, corp action. Here you can say pricing, right? And then of course your posting entries and preparation of final accounting or trial or posting entries. After that we would see the general ledger system, group ledger system, right? And when you prepare the group ledger, then automatically we need to record the all entries to the trial balance. When you prepare the trial, then you can compute the NAV, net assets value of a fund, right? Those are the activities which comes under NAV package. Okay. So from a fund accounting, hedge fund accounting perspective, in a hedge fund, you would see the structure of general partner and limited partner. In a mutual fund, directly that you would have seen investors, right? But in a hedge fund, you would see the general partner and limited partner. General partner, it means promoter of who take care of daily activities, fundraising, investing, right? Management, or day-to-day activities. They take care of all day-to-day activities. Limited partners, investors, they will be only entitled for investment only. So it means general partners, the raised fund from the limited partners. And both they can appoint admin. It's kind of a partnership business. Admin like Apex, which can provide accounting, reporting, reconciliations, portfolio accounting, tax, filing, compliance, regulatory services to both general partners and limited partners. And that's what your job come into picture as an accountant. So you would see multiple activities that you need to perform. Means you can relate all that activities with, it means NAV package you can relate here. So institution like Apex, they offer all that activities to the general partners because they both come together and they form fund. Let's say they form uh, Mars fund, right? If they form Mars fund, so of course they contribute. Let's say general partner contribute 20 and limited partners contribute 80. And then fund size is around, let's say, 1000. And same you can relate that with the balance sheets, with a subscription, which your Apex team will process the accounting entry for a subscription 100 because general partner and limited partners both will subscribe the units and then you will receive the subscription request, so which you can confirm it and record that subscription in the books of fund. We have already recorded subscription. If you go back and check it, this share capital, right? So here you can mention the GP. There's something happened with this slide. Anyways, but we recorded already, right? So we recorded subscription, and that's when you can link. So it means when general partner and limited partners they contribute, so your job come into picture to evaluate the notices or bank balance of a fund, and accordingly you can prepare the accounting entries, because every single transaction you would see, that will be recorded in your bank account or maybe broker account or custodian account. Holding related information, if you hold any stock, then that information you can check it in custodian account. Then derivative contract related information you can check it on a broker statement. Derivative, it can be swap, it can be options, futures, or any even loan position for that matter. So you can check that information or input on broker statement, right? And cash information, it means if you see subscription redemption or any buy and sell, information if you want, or any single, see, bank account hold the information for all the transactions. If you see, if you have opened your demat account or your trading account with any broker, so at that time they would have asked you to update your bank account, if I'm not wrong, right? So it means whenever holding, whenever you if you want to purchase anything, you need to add the cash to your bank account, but that bank account will be linked with the trading account. Trading account is nothing but, so where that will provide you the access of market where you can buy and sell the securities, right? And once you buy and sell, when you buy the securities and if you want to hold, then on a T+2 basis, then here settlement cycle will come into picture. Your security will be transferred to the your demat account, and that's what your broker your demat account statement matter a lot, where you can verify your holding or asset information. Okay, so here management fees, see, the general partners and limited partners they can decide the management fee structure, because management fees both partner will pay it to manage their daily expenses. 2% they can have a management fees, but it's a standard ratio, 2 to 3% at the moment. Management fees 2 to 3% on EUM means this, asset under management, and 20% performance fees. I'll explain you with the same example. Same example, just take it. So your balance sheets, cash we record 500, investment we record 500, right? And share capital. So this is your current balance sheet position. And what's the current NAV? 1 rupees. Okay. If now we'll talk about the other terms, so it means incentive fees. Incentive fees, it's like a commission. You may expect question on calculation of incentive fees, right? So now you know your basic I means details about your balance sheet size, right? NAV, current NAV for per unit. This is your current scenario. So you let's say discuss with your fund manager and decide high water mark, which is benchmark. Mark. Let's say you discussed with your fund manager and decide the high water mark, that is 20% return that you are expecting, right? 20% return you are expecting. एक minute. Benchmark, which is 20% return the investors are expecting, and this scenario let's say comes under your hard hurdle rate, right? So you would see this commentary. Let's say initially it was decided, or it was like this, but later on, see, funds funds main activity is to invest, right? Funds main activity is to invest and generate some alpha or generate some return for their investors. So let's say at the end of the quarter, or let's take the example, this was an annual process. At the end of the year, fund got appreciated and fund reached to the means extra value around 1000 extra. Why? So let's say Wipro performed well and it reached to the triple the valuation, and the current market price of the Wipro is, let's say, something different. Let's say around 1500. Then your total assets computation would be 2000, right? 2000. And here you can say earning. Return earning, or you can say like appreciation of assets. Appreciation assets of 1000, 2000, it will die. Correct? But point here is now you computed the balances, and if you calculate the net assets value, calculate it. Total assets should be your cash plus investment plus appreciation, or minus depreciation also, you can see if you have any, and then total outstanding units. Total outstanding units. So we have a total assets of 2000. divided by 8 units 1000. That becomes 2 rupees per shares. Right? Okay. Now come to this commentary and check it. So you committed to the fund managers. If fund reached to the 20% 20% return, then you can pay the incentive fees to the fund managers above the 20% returns of a fund, because this is a hard hurdle rate. This is a hard hurdle rate. Hurdle rate, it is nothing but it's a benchmark or promise made by the fund managers to the investors for an alpha or return on investment, I would say. Okay.
So
It's not exactly, it's not a performance fee, it's a benchmark. Benchmark, it means at the moment, like they have just, fund manager just made a promise. So they will be able to deliver the minimum 20% return. Right? Let me calculate, then you will get the idea, means what is the scenario exactly or what story that will come out from this. Now you actually calculate your balance sheet return as per the balance sheets. Go and check it. It was the NAV for per shares, correct? Yes, no, maybe. It was 1 rupees for per share. But what is the current scenario? Not 20%. Forget this portion. Just brief about this. What's the current NAV? 2. What was your first NAV, means basic NAV? 1. If I ask you to calculate return,
the 1 rupee
1 divided by 1 would be 100%. So you got the 100% return from fund, but you promise, or as a, let's say, you can treat me as a fund manager. I promised you, if I deliver you 20% return, then above 20% return, above 20%, whatever the percentage remains, I would expect, as a fund manager, I would expect commission of 20%. Commission of 20% means incentive fees. Incentive fees, you can call it as a performance fees. Performance fees. Performance, it means a fund should be performed above 20%. Above 20%. So it means if I calculate the 20%, calculate it and tell me how much it would be. 0.20, right? So a fund made the 1 rupees 20 paisa for per unit, then whatever the remaining amount would be, so I would expect to receive incentive fees on that. Just calculate first of all the equation. Current assets value for per unit, how much? 2 minus base value. What was the base value? 1 minus high water mark, not 20%. When you calculate 20, it would be. Now calculate and tell me remaining balance.
20.8 they will get this fees, right?
Exactly. Calculate 20%, 20% on 0.80. Calculate it and pay that as an incentive fees to the investor. So
So
this,
the performance fee calculated on the over and above high watermark, right?
yes, high watermark. But if it is a soft, then you can calculate on entire thing, entire 100%. Yes, that's the difference between hard and soft. The criteria would be remain same, but here when we say soft, it means fund need to achieve the 20% to get the fees on 100%. And with the hard, it means except means when the fund achieve 20%, then only if you see any above return, like let's say 30, 40, 100, whatever it is, then on that percentage only you would expect the incentive fees or performance fees. That's the difference, and that's how you can calculate your incentive fees. Right? So in a fund, in a hedge fund, so you would see the multi-series accounting method just because of incentive fees calculation purpose. So how they do it, I'll just brief about it, the important areas. Let's say there is a GMT fund. GMT fund will create classes, right? Class A, class B, or maybe class C. And then each class you would see the different series. Series A, Series B, Series C. Correct? Series AB. So what is the purpose of this multi-series method? This method we call it as a multi-series method. Multi-series method. Why this method is famous in a hedge fund accounting? So there are three structures. Standalone. Standalone, it means single fund that you can manage. Then this one you can say uh, your master and feeder also. Master and feeder, it means there would be one master fund, and each fund you can call it as the master feeder funds. And the other structure would be composite. Composite, it means instead there would be one master fund, but each fund you can see that you can treat as a sub fund instead feeder, and that each sub fund will have a different features. But again, the point here is why multi-series method come into picture. Just because of complex incentive fees calculation process, the funds come up with the multi-series accounting method. So it means for each series, you can charge separate management fees and incentive fees. As well as you can also publish the NAV separately for each series. And at the end of the year, if that series meets your 2 and 20% benchmark, means this threshold of manage incentive fees calculation, right? If they meet, then automatically all that NAV that series will be merged into their classes, and they can form a new series again. So they can merge at the end of the year. Let's say benchmark met, A series met, B series met, C series. Their total assets will be collated or merged in class C, because class C will be the main series for the series ABC, right? Series ABC that we have just created for a temporary purpose. And at the end of the year, if fund deliver that committed return for that particular series, then all series it will merge, and this will happen on a every year basis. And what if XYZ series, let's say, not met? Not met, it means that's fine. Then you can continue with that series until that reaches to the high water mark. Until that reaches to the high water mark. And if it is reached, then you can again merge. The same treatment will be applied to all series. But this method will help you to calculate the incentive fees easily. Otherwise, if you invite investment, let's say one investor received in January, then other investment joined that fund in March, and let's say every month you have received two investors, then how will you manage that? That becomes difficult for you, right? Exactly. But if you create separate series for them and maintain that, that will easy. Of course, that will easy. Yes.
last year, given this effect for effect
Hmm.
last year.
Hmm.
So I have a question.
Hmm.
One of your investor has started investing in point at the start of the year, the beginning of the year, that's January.
Hmm.
And some the next investor has started investing on the point from starting this event of the like this.
Hmm.
So how will you calculate the performance for the both the investor?
Calculate the NAV for A investor. A enter in Jan. Calculate the NAV for him first, and then calculate the NAV for him first. See, and that's what multi-series come into picture. Whenever you receive separate means investor, then you can create a separate series and maintain the separate incentive fees percentage and all for that particular investor. And why this question come into picture? Just because of, if you don't have a multi-series method, then that becomes difficult for you to manage it. So in this particular scenario, if you see, you have received one investor in the month of January, but NAV calculation cycle, let's say you have a quarterly. So for this particular investor, you can calculate the NAV in the month of March and pay the fees or charge the fees, right? Because quarterly we pay or charge it. Let's say quarterly NAV was reached at 120. Then whatever percentage that you decided, you can charge NAV, let's say on a 20, that incentive fees, and incentive fees will be paid. On a 120, incentive fees will be paid. Let's say high watermark was this. So 120, you paid 20%. Just calculate it. Would be around 4 that you have paid it. So the point here is why this point come into picture, and I mean what was expected there. So this investor paid 4, right? Incentive fees. And at the when the new investor, let's say, entered in June, means B guy entered in June, and while means at the time of subscribing units, the NAV was 120. Let's say one NAV was 120. Now just put a logic. This guy already paid the incentive fees of 4, correct? But B will get the benefit of that. B will buy the NAV at 120. Let's say June quarter ends at September, June, July, August, or September. July, August, September, right? September ends the quarter, and then fund reach to the 150. So just think about it. This guy is, ride freely. Why ride freely? We'll calculate both the scenarios. When the person entered in June, see the benchmark. The next benchmark was high watermark was, let's say high watermark was 120, because if you paid fees on 120, then that becomes the high watermark for next time automatically. Calculate the return for a B first. 150 minus 120, 30. Calculate 20% on 30. Calculate it. 6. Same calculate for person who entered in Jan. 130 minus 120. 30 into 20%. Calculate it. It will be. It will be 6. Now just calculate the return. Total return. If you see 26 rupees earned by the B investor, right? Net, if you see, because 30 minus 6, if you just do it, 24, sorry, right? 24. And this person also earned 24. But point here is that guy, so it means A already paid fees for this quarter also. Total fees and total return, just if you just calculate, we'll calculate the return. The person who entered in Jan invested 100 and his value reached to 150 at the September end, but he paid total incentive fees. Firstly he paid 4 and then he paid 6. Total 10 rupees fees he paid, right? Then earning was, total NAV was 140 for A, and if I ask you to calculate the return, it becomes 40%. Right? Same for B investor, entered in June, who invested 120, let's say, who invested 120, got the return. The fund reached to the 150 quickly, so it means 150 minus 120, that becomes 30. Who earned the return 30, paid fees 6, net benefit 24. And if I ask you to calculate the return, 24 divided by 120. Calculate it in percentage. This amount divided by return. Percentage would be 28.8. And if I ask you to just calculate the net fees for this particular quarter, so here again, if you see up to 120, that guy paid it. The current NAV was 50. Again, net would be 30. 30 on 20% becomes 6. And then 24 divided by again 120 for him. Right? 120 for him. So that becomes 28.8. Now tell me, it's a genuine question from the the other investor. Think from the investor perspective. I have entered initially, right? I'm also getting 28% return, and then person who entered lately, that guy is also getting 28% return. But fees we are paying equally. He will say, I have already paid 4 and plus 6, 10. And this guy paid only 6, but getting equal return. Why should I do this? Take it in a personal way. You entered here and I entered here. Don't you think that this is a kind of like uh, injustice for their, for A investor or B? So ultimately, see, he will say that I have invested initially. I push this NAV to 120, and that's what guy entered at 120, right? So it means, see, ultimately he's zealous on like he paid 4 rupees extra, but he's getting equal return. The expenses, who is bearing high expenses? Of course, the A bear high expenses, and that's what the point here was, and what the panel was expecting from you. So this is a free ride. So this guy sitting free ride. And how you can avoid it? You can avoid free ride by multi-series method. Create separate series for each investor, maintain it. If that investor meet the high watermark if that reaches, then you can transfer that entire assets, means you can liquidate that series and add it to the main. Simple. So this is how you can avoid it. Yes. New series, it means there will be main series, main class, right? You can liquidate the series and transfer that to the class. Because class also maintain the NAV.
Okay, accumulated of all this series ABC, you will see accumulated total of into the class.
Exactly. If that series met the high water mark, then automatically that series will liquidate at the end of the year and transfer to the class. Then class will maintain that further. Okay.
Okay, so this fund structure is like standalone, multi-class, and multi-manager.
Here there are three structures. Standalone, it means one fund under one, means one fund only that you can manage. It's a single fund. Master and feeder, it means there would be one master, the GMT fund master, and each class you can treat like a feeder. This structure, the master feeder structure, is best for a tax management purpose. Question you might expect: can mean single investor directly invest into master? Say it yes, they can. That's fine. And composite, it means instead feeder you can treat as a sub funds. Means every series comes with a different feature that can offer to the investors. Different features that can be offered to the investors. So now I would expect questions from you. Means, see, I have a lot of things to say, but let me just tell you something. You may expect questions on product knowledge as well. Product like bonds, debentures, equities, right? In a fund accounting interview, always you would expect question on basics of accounting that we have covered. Even though important areas we have covered it.
So, given the interview, what in the last like this.
Just give me a moment. I'll then ask. Means I'll take your questions.
Yeah.
Fund accounting, in a fund accounting interview, see, the basics of accounting is played very crucial role, right? Including entries, postings, prepaid expense, P&L, balance sheets. or NAV calculations. NAV calculation we have discussed with couple of examples, right? And then other your NAV package activities, little bit about corporate actions, maybe rule, X date, record date. So do you have any confusion in corporate action rule?
Sorry.
Corporate action rule. I'm asking you, do you have any confusion in corporate action rule? So I can elaborate that.
Action rules, I don't have it, but record date and exit you can.
Okay. So basics of accounting. Product knowledge that plays crucial role. So go through about debenture, bonds, equities, money market instruments, and all. Okay. And then your NAV package. Third would be your NAV package. So we have covered the NAV package, but yeah, I'll walk you through the corporate actions. Corporate actions. In a corporate action, you would see X date and record date. Record date, you can call it as a book close date or actual settlement date. So actual settlement date, so it means we had a rule T plus 2, but now it has been changed T plus 1. And we don't have the difference in X date and record date just because of settlement rule. In Indian market, you can treat as X date is equal to record date. Okay. So X date, who announce X date? Exchange. Stock exchange announce it. X date, it means expiry of dividend date. Expiry of a dividend date. Who announce record date? Company announce it. That's the difference. Company pay the corporate action benefit as per the record date. Company pay the benefit as per the record date. And investor calculate the benefit calculate the benefits as per the extent. Write down this. So you might expect question here like, if I purchase the equity on X date, will I get the benefit of corporate action? No. Seller will get the benefit of corporate action if seller sell the security on X date. Okay. And question would be like, if I buy the securities before the X date, then will I get the benefit of, see, the definition of the corporate action is, it's a rule, I would say, it's very simple. Security should be buy before the X date. And X minus 1 would be your entitlement date. So minimum requirement is at least you should buy the security on entitlement date. So it means X minus, let's say today is the X date, then yesterday would be your entitlement date. So you should have purchased the security yesterday and hold the security today because today is the X date. Then automatically you will get the benefit of corporate actions. And if you don't follow this rule, then you will not receive any benefits of corporate action. As simple as that. Because company don't check the X date. Company directly check the record date. If your name is there in the books of company on record date, then company will process the benefit to you. Simple. And X date, it is for an investor purpose where they can check the expiry of dividend, and accordingly they can place the trades and all. So that's what your recorded come into picture, or exit come into picture. So now I'll okay. Anything else apart from this, or else I'll take your questions then.
No, this is okay. Just one.
Okay. Go ahead with your questions now.
This helper point only basic thing I have.
Fund of fund. It's just kind of like the one fund will invest into other funds. Let's say other funds. It means other companies fund, other AMC's funds as well. Let's say Axis, ICICI, and Motilal Oswal. Motilal Oswal. So they are the AMCs, right? They have, let's say, Axis has, let's say, Axis Direct Fund. ICICI Direct, and Motilal Oswal, let's say, Tech Fund. These are the funds. You have 100 rupees. You can invest 50 here, 20 here, 30 here. So in that way you can invest, and that strategy you can call it as fund. Let's say you are also fund. It means you are a GMT fund. So you raise the investment from the investors, and instead investing on your own, you invested in funds. Okay, why you invested? Because Axis Fund delivered 29% return, ICICI delivered 30% return. I'm just assuming, okay. This is just an example. Let's say Motilal Oswal delivered 50% return, and that's what you invested into it. And small funds, they do the same thing. Let's say I'm an investor, I'll raise the fund and invest into mutual funds, invest into hedge funds, because I don't have a structure, right? I don't have a structure. I don't have my team. So why should I do it? Then I'll invest it. It's normal, like when you invest into multiple mutual funds through a SIP program, that becomes fund of fund for you. The same strategy will be applied for funds as well. If the funds invest into multiple funds, that becomes your fund of funds. From accounting wise, when the fund invests in XYZ funds, that fund will treat as an investment. Investment in A fund, investment in B fund, investment in ICICI direct fund, and that will be the asset side entry. Investment in Axis Fund account debit to cash and bank.
Part of what can be this one point investing into other community also is like a fund, right?
Yeah, one fund invests into multiple or other funds.
Now, this gap, what can we have gap? It's correct. After paying all the expenses, like that we are paying it, say, so,
Yeah, and now difference that you are asking,
yes,
before the calculation of incentive fees, that becomes your gap, gross asset value. After the calculation or deduction of incentive fees, that becomes your NAV, net assets value per unit. That's the difference.
just this
Basics of the derivatives. Derivatives, it means contract of financial instrument. Contract of instruments. So you are not buying anything, you are buying the contracts. That means you are buying the position or you're buying the rights. Buying the rights to buy something or sell something at certain date or at certain price or predefined price. Correct? So you are just buying the rights of holding position. Contract, it means position. Derivative, it means. And for example, if I take the example of options, option gives the rights of buy. So it means call option. Sell, it means put. So you can sell something, you can put something. If you sell something in a derivative language, we call it as a short as well, shorting. And in an option, especially if you sell something, we call it as writer, option writer. Buy, we call it as a long, and if you enter into any buy option, then we call it as a holder of the option. Holder of the option pays premium. If something goes wrong, then total loss will be total premium paid. It is kind of an insurance policy. Total premium paid will be the total loss. Here, premium holder paid premium to the writer. So it means writer total income. Total income would be total premium received by holder. But risk would be unlimited. Unlimited. And here risk will be limited. Limited risk, unlimited profit. Opposite, exactly opposite. Limited profit. Sorry, loss. And unlimited profit.
For this prices went down, right? The profit.
Yeah, depends. If you are at a buy side, then always you would expect like price it should goes up. That would be a speculation. And if you write it down, then you expect like price, let's say now this, but you if you let's say you purchase P or maybe call right. If you write the call, then you expect like price it should go down. Then only you can make a profit, right? Call, normal call and put sell, that will be in the same direction. Normal call and put sell, that would be like same in the same direction. If market goes up, then call option holder can make a profit or put sell holder can make a profit. Normal put option and call seller, if the market goes down, then they make a profit. Call sell, I'm talking about call sell, it means you short that call option. And about, okay, options will have a weekly expiry. Every week it will expire. Okay, so you would expect this input. What about futures? it required margin to pay for futures. Futures will have a monthly expiry. Read about little bit margin. We don't have much time, so I won't be able to go in details about margin. But let me just brief you about margin. Margin works with current market price. Let's say current market price is 100 and you paid margin, let's say, which is margin 10. So it means that becomes your 10% margin on current market price, right? And if market price changes, let's say market price reach to the 120, then that 20 will add it here. And then total closing balance or mark to market value would be 30. Because 10 your initial margin plus 20 profit. Let's say current market price change and reach to the 90, then there will be change in 30. So in that case, broker will directly store up the position automatically. Otherwise, you will have to pay the margin back, minimum margin, whatever the requirement would be. So it means margin and your market price, those work in the same direction. If there is a change in price, then there will be change in margin. Okay, and that's what you mark to market come into picture. So that you can treat as a 20, you can treat as an unrealized gain. Future and options you can buy in lots. Okay. Yes, one lots. Let's say if you want to buy 100 lots, then hundreds into lot number. Maybe in one lots, let's assume it there are 20 shares. And if you want to buy 100, 100 into 20. Whatever the number would be, let's say 2000. 2000 into price. In that way, you can calculate the exposure. Number into lots into price. And about swaps. Swap means it's an exchange. Exchange of cash flows and exchange of risk. Risk, it means your CDS. You can relate with the term insurance or motor insurance, motor vehicle insurance. Let's say we invested in Adani. You invested 1000 in Adani bonds. You invested for 10 years, but you got the news like Adani might be that will default on their investment at the time of repayment of capital to the investor back. Correct? You got that insight. Then how will you protect to your 1000 investment? Of course, you will find some insurer, right? Then you can pay, let's say, 1 rupees for one for per year for next 10 year. To whom? To the insurance company. If something happened to the investment, then insurance company will pay the entire amount to you. And that's what insurance companies sold the protection. Who sold the protection? Insurance. So in India, LIC, Life Insurance Corporation, is the major, player in the CDS market, credit default swaps market. And in US, FDIC, Federal Government Insurance Company, something, or Federal Insurance Body, they sell the or I believe AIG, if I'm not wrong. America's Insurance Group, something. American Insurance Group company sell the CDS protection. And exchange of cash flow, it means interest payment that you can claim. One counterparty can exchange the fixed, another can exchange the floating. Let's say if exchange fixed is paying 10% and floating is paying 12%. So here the 2% would be the net exchange. So they can exchange on a yearly basis or quarterly basis or monthly basis. So that depends. But notional amount, it should be loan. 10,000. So it means on 10,000, E will pay 10%. Let's say currently paying 10%. B is paying 10%, 12%. So B want to exchange with A and A want to exchange with B. So it means net B will exchange 2% with A. That's it.
So do you have something that I can prepare for that?
Go through my blogs. Okay, I have already posted blogs. Visit to my website. You would see a lot of insightful information. IB Fund accounting.com. Visit this site.
Particularly this is for effects.
See, Apex, it means anyways Apex, Setco, any institution, if you take the name, so you should read about investment accounting and all, right?
Yes.
So it's not something specially that you need to follow for their Apex and all. Everywhere that you would see the humans, so you should follow you as normal processing flow. Go through this blog. See this, all the activities that we have covered here. As I said, like product knowledge also plays crucial role. But if you explain, see, I would request you to prepare small examples, okay? Small examples for each and every activity. Let's say prepaid expense or already prepared it. Do some framework. Don't directly sit for interview. Prepare example, take the small amounts. Let's say 10 rupees, 20 rupees, 100 rupees. Prepare the small examples in case of derivatives, bonds, debentures. And always don't explain line by line. Say it for example and then brief about or put that example in the discussion. So that doesn't make any sense if you explain like line by line to to the panel. So nobody is interested. Prepaid expense. If they ask about prepaid expense, then say prepaid expense. It means expenses paid in advance for a next accounting period. For example, admin fees. We have paid it for next accounting period. So in that way, you can explain it. And then brief, first of all, see, already you should chart out examples for each and every line. Let's say incentive fees. Why don't you prepare one small example? So within a 30-second that you can explain. But most of the guys, what you follow, like you follow the process where you explain it just theoretical 2 to 3 lines and your job is done. No. And for a when you say any question like what do you understand about NAV calculation? So don't say total assets minus total liabilities. Say it NAV calculation. It means it's the measurement of assets, liabilities, expenses, and income for that particular accounting period. Let's say if the accounting period is daily, then we'll have to compute the assets, liabilities, expenses, and income for that particular day. And if it is monthly or quarterly, then we'll follow that cycle. And then you can put it into, and even we have a formula that contains like total assets, measurement of total assets, then brief few names like dividends, receivable, prepaid expenses, investment in securities, bonds, options, right? Computation of all this, that becomes the total assets minus the outstanding expenses, management fees, admin fees, redemptions, payable, or if you see any, that becomes a total liability. So total expense minus total assets minus total liabilities divided by number of outstanding units. Let's say 2 units, 3 units, 100 units. So why don't you prepare? We have discussed the example. So why don't you prepare that example? If you explain like this, trust me, 100% it will get shortlisted. 100%. If you follow this technique, he will text me, sir, I got this selected for this interview. But if you just theoretically explain it, so nobody is interested. Trust me, I also hire people. So I'm not interested in theoretical lines, 2 to 3 lines. I would expect the more impactful discussion with examples. Okay? Yep.
Can we prepare this whatever? So, decide what all example we have discussed with it. So see.
Okay. Yep. You can. Yep. You can.